All right, so let's dive into a world that used to be reserved for the super rich, professional sports investing.
Right.
I've got a stack of research here, including a deep dive from JP Morgan and some recent news, and it looks like things are changing fast. You ready to see if we can find you a winning team?
I am ready. It's fascinating to see how private equity is opening up opportunities that were once only available to billionaires.
That's right. We're not talking about just buying a jersey anymore.
Right.
This is about owning a piece of the action. But before we get into the nitty-gritty of valuations and potential pitfalls, let's set the stage. Historically, who owned these teams?
We're talking individuals with massive net worths, often in the billions.
Yeah.
Think names like Steve Ballmer, who owns the LA Clippers, or Jerry Jones with the Dallas Cowboys. These aren't your everyday investors.
Definitely not. But the rules of the game are changing. Private equity firms are now allowed to buy minority stakes in teams, even multiple teams. So does that mean someone like you could get a piece of the pie?
Well, not directly. You'd be investing in a fund that then owns part of a team.
Yeah.
But it's still a huge shift. We're seeing this across the board in the NBA, MLB, NHL, and MLS.
Okay, so walk me through the specifics. What are the rules around these private equity investments?
Each league has its own set of regulations. For example, the NBA only started allowing this in 2021, and they limit how much a single firm can own and how many teams they can invest in. It's all about maintaining a balance of power.
That makes sense. Now, we know there are a few publicly traded teams out there, like the Green Bay Packers, but I imagine actually getting control is a whole other ballgame, right?
You got it. Even with publicly traded teams, voting power often rests with the majority owner. Take the Atlanta Braves. Their Class B shares have 10 times the voting power of the publicly available ones. So you might own a tiny slice, but you won't be calling the shots.
So it seems like the real opportunity here lies with these private equity investments. But with everyone wanting in, I imagine valuations are going through the roof.
You're not wrong. Sports franchise valuations have been skyrocketing, outpacing even the S&P 500. But to understand why, we need to look at how these teams actually make money.
Okay, let's unpack that. What are the main revenue streams for a sports team owner?
There are three primary sources. First, you've got league distributions. Think of it as a big pot of money from national TV deals and merchandising that gets split between all the teams.
Okay.
Then there's what the JP Morgan report calls local brand building and premium entertainment.
Okay.
This is where things get interesting because it encompasses everything from ticket sales on luxury boxes to local media deals. Finally, you've got ancillary businesses, which might include things like real estate development around the stadium.
So you're not just buying a team, you're investing in a whole entertainment ecosystem.
Exactly. And here's another key factor that drives those high valuations. U.S. sports leagues essentially operate as unregulated monopolies. They have a level of control over their sport that wouldn't fly in other industries.
Monopolies, huh? I guess that explains why owning a team is such a coveted prize. But how do they actually put a price tag on a team? It's not like checking the stock market, right?
Nope, no ticker symbol for the Yankees. But sources like Forbes and Sportico have become surprisingly accurate at predicting team valuations. They look at a combination of factors like revenue, profitability, and even brand strength.
Well, considering those valuations are soaring, I have to ask, just how much higher are we talking compared to, say, the stock market?
Hold on tight, because since 2005, sports franchises have significantly outpaced the S&P 500.
Wow.
And when it comes to multiples, most teams are valued at 5 to 12 times their sales.
Okay.
Compare that to the S&P 500 average of around 3 times sales.
Yeah.
We're talking a serious premium.
Wow, that's a huge difference. But is it the same across all the leagues? Or are some sports hotter than others?
There is some variation. The MLB, for instance, has the widest range of valuations. This is partly because they have less revenue sharing and no salary cap, making them a bit more unpredictable.
So baseball is a bit of a wild card then. More risk, but potentially more reward.
You could say that. But speaking of risk, let's talk about debt. You might think with these sky-high valuations, teams are drowning in loans, but that's not always the case.
Really? I'm surprised. Why not?
Well, the NFL and NBA have strict debt caps, and most teams across all leagues have surprisingly low debt levels. They also have these incredibly valuable long-term broadcast contracts that give them a steady stream of income.
Ah, those legendary broadcast deals. I bet they're worth a fortune.
They absolutely are, and they play a huge role in driving valuations. But it's not all smooth sailing. The media landscape is undergoing a massive shift with the rise of streaming and the decline of those old-school regional sports networks, creating a lot of uncertainty.
The streaming wars, Netflix, Amazon, Apple, everyone's fighting for a piece of the sports pie. How is all this impacting those regional networks? I've heard they're in trouble.
They are. Take Diamond Sports Group, for instance. They declared bankruptcy and defaulted on contracts with MLB, NBA, and NHL teams. It's a huge shakeup. Some teams are scrambling to produce their own broadcasts, while others are cutting deals with streaming platforms. It's a volatile situation, especially for baseball, which has always relied heavily on local media deals.
So streaming, a blessing for some, a curse for others. It sounds like a wild west out there. But it's not just the media landscape that's changing, right? What about actually going to the games? What's happening with attendance and ticket prices?
That's a great point. The cost of a night at the ballpark is definitely a consideration for any potential investor, and that's exactly what we'll dive into next.
Okay, so let's talk about the fan experience. If you're thinking about owning a piece of a team, you got to consider those butts in the seats, right?
Absolutely. The in-person experience is still a huge part of the sports business, and thankfully for most major leagues, attendance is holding steady or even rising after that COVID dip. The NFL, NBA, and NHL are all seeing good numbers.
That's good news. But what about baseball? Didn't you say earlier they were having some troubles?
Yeah, they are facing some challenges with attendance, but it's a complex issue with a lot of factors at play. We won't get into all of it now, but it's definitely something to keep an eye on if you're thinking about investing in an MLB team.
Noted. But even with steady attendance in those other leagues, I bet ticket prices are still going up, right? I mean, going to a game these days feels like a luxury experience.
You're right. Ticket prices are definitely increasing faster than inflation, even with those stable attendance figures. And it's all thanks to those premium seats and luxury boxes. Those are where teams are seeing the biggest revenue jumps.
Makes sense. It's all about catering to the high rollers. But let's be real. Sometimes you just want a good old-fashioned hot dog and a beer at the game. How much is that setting fans back these days?
Well, that depends on where you go. The JP Morgan report actually breaks down the most and least expensive NFL stadiums for those classic game day snacks.
Okay, I'm intrigued. Which stadium is going to break the bank?
Get ready for this. At SoFi Stadium, home to the Rams and Chargers in LA, a beer will set you back a whopping $18.
Ouch. That's more than I pay for a six-pack at the grocery store.
Right. But if you're looking for a bargain, head to Soldier Field in Chicago, where you can snag a beer for just $6.
Now that's a price I can get behind.
Yeah.
Okay, so stadium choice definitely matters for your wallet. But let's talk about something even bigger. Stadium subsidies. I know this is a controversial topic, and I'm curious to hear what the research says.
It's a hot-button issue for sure.
Yeah?
The JP Morgan report reveals that public funding for sports stadiums has been substantial since the 1970s. And while the percentage of construction costs covered by taxpayers has been going down, the overall cost of building these mega stadiums keeps rising. So we're still talking about huge amounts of taxpayer money going into these projects.
So even though it seems like we're contributing less, the actual dollar amount is still massive.
Exactly. And that public funding can have a major impact on team valuations. Take the Las Vegas Raiders, for example. They got a whopping $750 million in taxpayer funding for their new stadium, and their valuation went from $1.4 billion in 2015 to over $6 billion today.
Wow, that's a pretty sweet deal for the Raiders. But is it fair to taxpayers? I mean, are these stadiums really delivering on those promised economic benefits?
That's the million-dollar question, isn't it?
Yeah.
And a 2022 meta-study actually concluded that the economic benefits are often overstated. Instead of creating new spending, it often just shifts spending from existing local businesses to the area around the stadium.
So it's not really creating new wealth, just moving it around.
Pretty much. And surveys show that both economists and the general public are largely against these subsidies. People are starting to see them for what they are, a transfer of wealth from taxpayers to team owners.
I get it. But with those soaring valuations, are teams even feeling the pressure to get public funding? Can't they just build these stadiums themselves?
Well, it's not always that simple. Remember, those valuations are based on future earnings potential, and a shiny new stadium is a big part of that equation. Plus, there's the whole issue of civic pride and the political pressure that comes with keeping a team in town.
It's a complex web of economics and politics, for sure. But let's shift gears for a moment and talk about what makes sports leagues themselves successful. It's not just about fancy stadiums and big money deals, right? The games themselves have to be compelling.
Absolutely. And that brings us to one of the most interesting aspects of U.S. sports: league parity.
Parity, what exactly does that mean?
It means that any team, regardless of market size or payroll, has a realistic chance of winning. It keeps things exciting and unpredictable, which is a huge draw for fans. You never know who's going to pull off an upset.
I like it. It's like the underdog story in sports. But how does this parity thing compare to European soccer, where it seems like the same few teams win everything?
It's a totally different ballgame. In European soccer, you've got powerhouse teams like Real Madrid and Bayern Munich that consistently dominate. But in the U.S., we've got mechanisms in place to level the playing field.
So you're saying the NFL is more like a democracy, while European soccer is more like an oligarchy?
You could put it that way. The J.P. Morgan report actually uses something called the Gini coefficient to measure parity. It's a fancy way of measuring how evenly things are distributed. A lower coefficient means a more level playing field, and guess what? U.S. leagues, especially the NFL, have significantly lower coefficients than European soccer.
So even those small market teams have a shot at the championship in the U.S. That's pretty cool. But how do they actually create this level playing field? What's the secret sauce?
Well, it's a combination of factors, but three key mechanisms stand out: revenue sharing, the draft, and salary caps.
Okay, break it down for me. How does each one contribute to parity?
Let's start with revenue sharing. Essentially, the richer teams help out the poorer teams. In the NFL, for example, all the national revenue from things like TV deals gets split evenly among all the teams. So even if you're the worst team in the league, you still get the same slice of the pie as the Super Bowl champs.
That's surprisingly egalitarian. It's like a Robin Hood system for the NFL.
Exactly. And then there's the draft, which is designed to give weaker teams a chance to rebuild by getting first pick of the most promising young talent. It prevents them from falling too far behind.
Makes sense. But don't those top draft picks demand huge salaries right out of the gate? Doesn't that negate the whole parity thing?
That's where rookie salary caps come in. They limit how much those young stars can earn, at least in their first few years. It's another way to keep those payrolls balanced and prevent teams from going on spending sprees for rookies.
So even if you draft a superstar, you can't just throw a blank check at them. You have to play within the rules. But what about those big spending owners who want to build a dynasty? Don't salary caps put a limit on how much they can spend?
They do. And that's a key factor in maintaining parity. The NFL, NHL, and NBA all have hard salary caps, which means teams can't exceed a certain payroll limit. This prevents those wealthy teams from just buying all the best players and creating an unfair advantage.
So even if you've got billions to burn, you can't just assemble an all-star team. You have to play smart and work within the system.
Exactly. Now, the MLB is a different story. They don't have a salary cap, which is why you see a wider gap between the big spenders and everyone else. But even they have a luxury tax that penalizes teams for excessive spending.
So there are still some financial incentives to keep those payrolls in check. But let's be honest, even with all these mechanisms in place, some owners are still going to overspend, right?
Oh, absolutely. The J.P. Morgan report actually has a whole section on the worst teams money can buy. These are the teams that spend a fortune but still perform terribly.
Sounds like a cautionary tale for any aspiring owner. But speaking of different systems, let's hop across the pond and talk about European soccer. You mentioned earlier that it's a different world in terms of parity, but what about the financial side of things? What makes it such a risky investment compared to U.S. sports?
One word: relegation.
Relegation, right. That's when teams get demoted to a lower league if they perform poorly. But how does that affect things financially?
It's a huge hit. The report shows that in the 2019-2020 English Premier League season, teams that got relegated saw their revenue drop by as much as 60%.
Wow, that's a massive financial cliff. No wonder European soccer is considered a riskier investment.
Exactly. And it's not just about the revenue drop. European teams also have less leverage over players because there are so many leagues out there. Unlike in the U.S., where leagues like the NBA and NFL offer significantly higher salaries, European players have more options.
So the players hold more power in the negotiations. They're not as tied to a specific team or league.
Right. And then there's the Ronaldo effect, where the transfer of a superstar like Cristiano Ronaldo can send shockwaves through a team's financials and even affect their stock price.
Like a whole other level of volatility. So it sounds like European soccer is a wild ride. Less parity, more risk, and a lot more financial uncertainty.
You got it. And on top of all that, they're grappling with a bunch of regulatory challenges. From tax investigations to concerns about money laundering, it's a complicated landscape.
It sounds like it. But we've covered a lot of ground here, from the ins and outs of ownership to the wild world of European soccer. Before we wrap things up, let's take a quick peek into the future. What about those emerging sports leagues? Are there any hidden gems out there for a savvy investor?
That's a great question, and is where things get really interesting. We'll explore some up-and-coming leagues and separate the hype from the reality right after this.
Okay, so we've explored the established leagues, but what about those up-and-comers? Are there any promising investment opportunities outside the Big Four?
There are definitely some intriguing options, but it's a bit of a high-risk, high-reward situation. Some leagues are showing real potential, while others might be overvalued.
All right, give me some examples. Which ones are catching your eye?
Well, we've seen some non-U.S. sports successfully transplant to the U.S., like Major League Soccer and Formula One.
Right.
MLS is attracting big-name sponsors, especially with Messi joining Inter Miami, and viewership for F1 races in the U.S. is booming.
So those are good signs for those leagues. But what about the more niche sports? Any diamonds in the rough there?
There are a few that are attracting private equity investment, but remember, monetizing digital views is tricky, and some of these leagues might be overvalued. The J.P. Morgan report mentions a few to watch, like the NBA's Africa League, the Drone Racing League, the Premier Lacrosse League, Professional Bull Riding, Major League Pickleball, and SailGP.
Wow, that's quite a mix. Pickleball, huh? I guess I need to get with the times. But what about women's sports? Are they attracting investment?
They are, and it's a really interesting space. Women's sports are projected to surpass $1 billion in revenue in 2024, driven by events like the FIFA Women's World Cup. We've also seen impressive growth in viewership for the NCAA Women's Basketball Tournament, and women's gymnastics is a perennial favorite at the Olympics.
So there's definitely a growing fan base, but are these leagues translating that into profits?
It's a mixed bag. The WNBA, for example, has pretty good attendance but generates far less revenue than the NBA. It's more about ticket prices, broadcast deals, and overall market size. And while the National Women's Soccer League, NWSL, secured a new broadcast deal and is seeing rising valuations, some teams are still struggling to break even.
So there's potential, but it's still early days for many of these leagues. They need to figure out how to turn that growing fan base into a sustainable business model.
Exactly. And that brings us to a sector that had a lot of hype but has recently hit a bit of a snag, esports.
Right. Esports was supposed to be the next big thing, but I've heard it's going through a rough patch. What's the story there?
Well, the initial hype and investment frenzy has definitely cooled down. The report calls it the esports winter. Viewership is declining, ad revenue is disappointing, and those sky-high expectations just haven't been met.
So what went wrong? Was it all just hype with no substance?
It's not that simple.
Yeah.
There's some underlying issues, like a lack of clear revenue streams and difficulty attracting mainstream sponsors.
Okay, so what are some specific examples of this esports downturn?
Take FaZe Clan, for instance. They went public through a SPAC, but their stock price tanked, they had massive layoffs, and eventually they were delisted. Then there's MSG, which tried to sell its esports team but couldn't find a buyer. Even Amazon Gaming had layoffs, and the Overwatch League is shutting down.
Yikes, that doesn't sound good. So is esports dead?
I wouldn't say dead, but is definitely going through a period of recalibration. Investors are being more cautious, and there's a focus on building a more sustainable foundation.
So maybe it's less about quick profits and more about long-term growth.
It's exactly. Global esports viewership is still growing, new brand partnerships are forming, and some investors are focusing on esports infrastructure and analytics, which could be smart plays in the long run.
It sounds like there are still opportunities for the right investor, but you really need to do your homework.
Absolutely.
Yeah.
This whole deep dive has been a masterclass in due diligence.
I know, right? My head is spinning with all this info, but in a good way. So before we sign off, let's recap some of the key takeaways for our listener. What are the big things they should keep in mind if they're thinking about dipping their toes into the world of sports investing?
Well, first and foremost, the landscape is changing rapidly. Private equity is opening up new avenues for ownership, but it's crucial to understand the rules and regulations of each league.
Right. You can't just waltz in and buy a team on a whim.
Exactly. And speaking of buying, valuations are sky high, so it's essential to understand the drivers of profitability. We've talked about those three main revenue streams: lead distributions, local brand building and premium entertainment, and ancillary businesses. And those are all key factors to consider.
And don't forget about those broadcast deals. They're a huge part of the equation, but the streaming wars are shaking things up, so that's another area to watch closely.
Absolutely. And then, of course, there's league parity. It's a unique feature of U.S. sports that contributes to their appeal and value. Those mechanisms like revenue sharing, the draft, and salary caps, they're all designed to level the playing field and keep things exciting.
It's what makes U.S. sports so unpredictable and so much fun to watch. But if you're looking for a more volatile, high-risk, high-reward scenario, European soccer might be your game. Just be prepared for the wild ride that comes with relegation.
And speaking of wild rides, those emerging sports leagues and esports, they're definitely areas to watch. But remember, it's all about due diligence. Research those revenue streams, understand the fan base, and be prepared for the ups and downs that come with any new venture.
Wise words. So, dear listener, we've thrown a lot of information at you today, but I hope it's given you a solid foundation for navigating this complex and exciting world. Remember, sports investing isn't just about passion. It's about understanding the business, the trends, and the potential pitfalls.
And remember, the metaverse is supposedly dead. But what if a sports league figures out how to make it work? Imagine attending a game from your couch and feeling like you're actually there.
That's a mind-blowing thought, and a perfect note to end on. A huge thank you to our expert guide for navigating this world with us, and to you, dear listener, for joining us on the deep dive. Until next time, keep exploring, keep questioning, and keep diving deep.